Hello and welcome to our market alert video for today, which is August 30, 2024. Thank you for watching. I am Ken Moraif. I am the founder and CEO of Retirement Planners of America. And we have a singular goal, which is to create as many SCWPS as we possibly can. And if you don't know what SCWPS are, SCWPS is the acronym for Second Childhood Without Parental Supervision. So when a client of ours retires, we call them a SCWPR, and we want them to get out of here, go play, have fun, enjoy. Have that second childhood. Let us worry about all this boring financial stuff for you. Our website is RPOA.com. So we have a lot to dive into, not the least of which is I'm very flattered by the fact that you guys listen and watch our content and then ask a lot of questions and stuff like that. So I want to address one of the big questions that you guys have been asking. But before I do, I got to give you a quick, a little bit embarrassing thing that happened this last week. I'm actually videoing this from Colorado, and I went hiking with an 84-year-old. Now, let me tell you, these people in Colorado are very, very fit, so he's a fit guy. And so we went on a 3-mile hike, and it's a mile and a half uphill, and I'm not exaggerating when I do this, to the top of a mountain, and then it's a mile and a half coming back down again. And as we were going up, he looks at me and he goes, "Is this pace good for you? Do we need to slow down?" And I'm like, "What? Give me what?" I gotta give you one of these. Anyway, he kicked my butt, I'll just say. So let's talk about, the questions that we're getting, which are, again, flattering, is we've been talking about, what we thought the bonds were going to do in the second half of this year. And so a lot of questions about, should we sell our bonds, sell stocks rather, and buy bonds instead? Since, Ken, you've said that the bonds are going to outperform the second half of this year versus stocks. And I get it. We correctly said sell stocks and bonds in April of 2022. And bonds, of course, had the worst bear market in history, according to Bloomberg. So that was a very good move. So I can see why people would wonder now that we're saying buy bonds, or have bonds. We also said that, the Fed would not lower interest rates this year until the second half of this year. A lot of people were saying in March of this year that we'd already be starting, and we correctly said that. We also said, as I said, that bonds would outperform stocks in the second half of the year, and so far they have, generally speaking. So I get why, if we're saying that you'd think, let's do that. Well, no. It's too late. Okay, we got back into bonds in December of last year, the latter part of December. It's too late now, okay, to get into bonds unless you're considering it as an alternative to a money market fund. Okay, that potentially could be a place where you might want to redeploy those dollars. But in terms of selling stocks so as to buy bonds, because bonds are going to outperform, most of the upside potential for bonds, in our view, or at least half of it at this point, has already happened. Okay, just the anticipation of the Fed lowering interest rates made the bond prices go up on the bond aggregate index. So it's already up about 5% just in the last 3 months. So what we said would happen is happening, but most of it is baked in. So would not recommend selling stocks. And again, I'm not recommending anything. This is just informational. You have to be a client for me to recommend anything to you. But we don't think it would necessarily be a good idea because of the fact that interest rates reduction has already been priced into the bond market. Over the next year, though, we do think, we got jobs numbers this morning, and they look pretty good. So that being the case, it looks like the economy is going to be okay. So from the stock standpoint, a year from now, we think we'll be much higher than we are today. And we think bonds will do well for the next 4, 5, 6 months. But that's why we don't think you should sell your stocks to do this. Now, if you have money in a money market fund and you're thinking, I want to get a better return over time, there's the potential there that as interest rates go down, the interest you're going to get in the money market fund will go down with it. And at the same time, bonds should go up in that scenario. So that might be a place for you to do that, but I'm not recommending anything because you're not a client. So, the other thing I would say is that you miss this video at your own peril, because we've been remarkably accurate here over the last several years, and certainly our strategy said to sell in November of 2007 before the stock market crash of 2008. So you don't watch these videos at your own peril. So I encourage you to subscribe, and you can click on the button below to do that. And by the way, while you're at it, you might as well listen to our podcast as well. It's very, very good. I highly recommend it. So thank you for watching. Next week, we are going to have a special edition on our election forecast. So make sure you tune in next week as well. So thanks for watching, and we'll talk soon.